Welcome everyone to our first digital investor meetup. We are super excited to have 1 hour with you and talk about our passion, which is precious metals and green tech metals and mining companies. So we have a pretty packed agenda here today, and we want to have this quite interactive dialogue with you guys, our current and future investors, to improve the communication with you guys and also get the opportunity to answer your questions. So we have prepared a bit of a short presentation, and we encourage you to ask us some questions during the presentation. So I will try to incorporate them while we speak. And if it's not taken up, we will answer more questions in the end. So this is the first digital meetup of 2023, and we will also do one every quarter. That is our goal. So I'm Christopher, and I'm a co-portfolio manager here at AuAg Funds. And you probably recognize the person next to me, Eric. Who are you?
Who am I? Of course, I'm the founder of AuAg Funds that started 2019, so it's still a young company. Also the portfolio manager, and been in the business for, I used to say plus 25, but I was counting it was almost plus 30 soon, so I have to change that.
Okay. Let's see here.
And if we leave us as persons, AuAg, as many know, it means gold and silver, and that's where we really started with the two precious metals. And we are really fascinated about precious metals, but also all other metals. And it's the properties of these metals, the unique properties that are so interesting for when we talk about money, it's interesting. And when we talk about green tech, the future of and the electrification of our world, they are very fascinating. Which are the best ones? Which do we need? Which can we mine? Which have troubles to mine, and so on. So this is really our passion. It goes beyond gold and silver, but today's topic is gold, silver, and mining companies. So we will this time stay with the gold and silver, and next meetup probably we have another topic.
Yes.
And what you see here is the periodic system in the background, and that's where it all comes from. As I said, the different properties with the different elements, and gold and silver is one of the mega trends that we do invest in, and the background to that is the trend of monetary inflation, and we will come back to that during the presentation. And then we have today's agenda, Christopher.
Yeah, so as you can see here in front of you, this is what we will talk about today. So shortly talk about gold and why it can be useful to include in a portfolio. We get a lot of questions around this topic from our investors. And then we will dig into our outlook that we actually wrote in December for 2023, which we have updated a bit, but it will mainly cover gold and how we see it performing going forward, also silver, and then we'll go into the mining companies. And towards the end, we will talk a bit about what we actually do and how to invest in this area. So let's kick it off with the first topic. And also, if you have any, if you can't hear us, something happens, just write in the chat. I have it here in front of me. And as I said, we want to keep this interactive. So make sure to ask your questions, because now's the time. So gold in a portfolio, why should you even consider including it? Here on the first slide, we have Ray Dalio's all-weather portfolio, and this is a model portfolio that he created that should work in all different circumstances or all investment environments. So as you can see here, it has 15% towards commodities, so 7.5% towards gold, and then you have a separate commodities leg. And this is what would work over a long time period. And then if you're look at investing during certain time periods that are shorter than maybe 20, 30 years, then you can consider increasing the weight towards commodities as I will talk about in a later slide. But before, the 60/40 portfolio is a very common model portfolio. It consists of 60% global equities and 40% bonds. And what we can see here in this chart is that 2022 was actually the worst performance of this portfolio in over 100 years. So this actually should, when you think about it, like this traditional portfolio, like maybe this is the time to question it because it hasn't worked. And here we have a thesis, and also Ray Dalio has been onto this, and many other famous investors, that maybe you should include something else in this portfolio and rethink it, because now we could see that this traditional portfolio.
And it is really interesting that we had this made this video 2020 about the perfect storm, the time when stocks and bonds go down at the same time, and we also created a fund for that concept. We won't talk about it too much today, but it really worked out well in 2022 when the perfect storm happened. So that was a great video, actually.
Yeah.
2 years early, but it happened.
Yeah. And that fund, in short, it's instead of bonds 40%, we have gold 40%, and then green tech equity instead of global. So that's was a really like an innovative way of reforming the 60/40 portfolio. That's how we usually talk about it. Okay, and here we have a chart describing the relative valuation of the commodities sector against the S&P 500. And here is what we really can see. And if you compare it to the model portfolio of Ray Dalio, or where many of us say you should be like maybe 10% gold or 15% gold and 20% commodities, something like that. But during market cycles, when you have a very low valuation on the sector, that's actually when you can consider increasing this. And we, like, if you take the 60/40 portfolio we have with 40% gold, because we see that these commodities are undervalued. And of course, when we are at these peaks like we had in 2008 here, when commodities were really high value in comparison to S&P 500, of course, then was when you sell and maybe go down to 5-10% commodities overall, and the rest stocks and other instruments. Okay, that was short about gold in a portfolio. Just to give you guys some an introduction on why this is even relevant, the rest of this slides that we will talk about, and why we think gold is so such an essential building block in a portfolio. And if we just look back a couple of months here, this is a 3-month chart, we can see that gold has been performing really well. It has come back a bit this month due to the central banks talking mainly that they will have the interest rates high during a longer time. It has come back a bit, but as we can see, the trend on a 3-month basis is still very positive. And if we
and maybe it's they were really strong in 2022 in the end, and it started good in 2023, and now before this meetup, of course, they came down, but the trend is still there. And actually, every time it comes down a little bit, we and our investors see that as a buying opportunity. So if you missed buying in this beginning of December, this coming down is a good time to either buy or just to add, and then to use. If you think gold in the long term will always go up, and as it has, it's good to buy a little bit more, use volatility to your advantage, to sell a little bit when it's up and then buy a little bit more again when it's coming down. So we don't see this as a trouble, but more like an opportunity every time it comes down.
Yeah. And if we zoom out even more back to 2019, this is the longer term trend of the gold price, and here we can also see a positive trend. And what we said in our outlook, and what we still believe, is that if that gold will go towards 2,100 USD per troy ounce towards the end of the year, and that's if our thesis and what we think will happen is correct, basically. And this is, of course, what we will talk about the rest of the presentation.
And that is really the beginning of the. I mean, we have had a some small bull markets, down markets for gold, but when the secular bull market starts, the big bull market, that's when the big returns are happening. So we really think we are there in the beginning, and we have the reasons also behind that.
Yeah. So if we look at some things we see ahead for gold, one of them is the manipulation of the markets, and that is quite a frequent topic here that surface when investors talk about gold, and it's manipulated back and forth. And we can see that across various asset classes. We had the nickel debacle in the spring, and we've actually seen quite a few banks now getting fines. And here is one example that JP Morgan had to pay $920 million for manipulating precious metals. And this is something we see will come to an end eventually, and is starting to unfold shortly but surely.
Yeah, and this has been going on for a long time. And if it's not, I mean, sometimes you say manipulation, but if nicer word would be managed markets, and it doesn't happen just in precious metals. We have seen this within electricity, within FX trades, currency trades, within interest rates. There have been a lot of fines for banks, and because the problem has been that the COMEX it's so big in trading, like a casino, and so it becomes larger than the physical market. So the price is set on the COMEX and not on the physical market, and this is not the way it was supposed to be. COMEX was supposed for producers to, if they needed to hedge their forward production. They don't do that anymore normally, so it's always only big banks doing this, and we saw what happened on the London Metal Exchange with the nickel debacle, and there is a risk that will happen also with precious metals, and that would be much larger. And if the regulators are good, they can stop this and maybe stop this managing of prices, and that would make a big uptick for the prices, especially for silver, but also a lot for gold. So we really hope to see an end to this and let the physical market dictate the price.
We actually got a question here. The first question, two maybe. The first one is: do you operate with an absolute price target of gold?
I would answer that that's not really important for us. I mean, we don't buy or sell. We are always long only. So we leave the decision to sell our funds to the investor. What we do see in monetary inflation is that gold is actually the constant, and it's the currencies that go up and down. And what we have seen since 1971, the big day, August 15th, when Nixon had to leave the gold standard because they were losing half of their gold reserves because they printed too much dollars. Since then, so it's like 50 years ago, the US dollar has lost 97% of its value. So for us, it's more gold is the constant. It's the currencies that lose their value due to monetary inflation, and that's what we see. Unfortunately, we will probably see more of it. So that's probably the answer to the question.
Yeah.
Or our answer to the question.
Yeah. Thank you, Eric. We've got one more from Elena. I think we can take that while we talk about the gold price. To what extent do your predictions depend on a new bull market for gold, I guess? To what extent do your predictions depend on a new bull market?
Well, again, it's as we said in the beginning, a mega trend, and the mega trend is monetary inflation. And what we always see is that politicians need an easier environment. No politicians can survive a real straightforward, good economy today. We need the debt. We are in a debt system. So we are pretty sure that more money will be printed. Of course, short-term prices are going up and down depending on what the market believes. And it's easy to believe when somebody say that they are going to have, for example, high rates for longer. When the market believes that may be a headwind for gold, and the dollar goes up short term because USD is not doing the pivot as expected. So short term, it's just a lot of speculations from the market, what is going to happen. But normally what they say is not what happens in the end. So we're not really worried about that. So in the long term, gold goes up or currencies actually go down, and gold is the constant again.
Okay, great. Keep them coming. And we'll continue. So another really interesting happening during last year was that we saw such a big increase in central banks buying gold. They have done it consistently since the last financial crisis because they didn't want to end up in the same situation again. So they have kind of increased their how much gold they hold, basically, because they know that that is the last resort or the last security they have in their vaults. So gold is crucial for a country to have to back up their fiat currency. And it was specifically in Q3 2022 we saw record.
And also it's also that they are buying a lot of gold since the financial crisis because they want to be in a safer position. But it also, what we do see is a lot of things are happening in the world around the currencies and FX, as we see China doing trades with India or Russia or whatever, and they are not doing it by going through the US dollar. So in the big picture, I would say a lot of very interesting things are happening about the world currency, the US dollar. So we think commodities will back, maybe not the US dollar, but maybe other currency constellations. So this is really, really interesting what is happening. And I think gold and silver and the precious metals are a good protection in this environment.
Yeah. So continuing, here we can see the balance sheet of the Federal Reserve, and we have kind of circled a few interesting points because they have, if we can see that when they have started to say that they will decrease their balance sheets, it has kind of worked for a bit, but then it has taken off again, and that is exactly what they have said this time as well. So we see a very high likelihood that they will have to pivot on what they have said and actually print more money because they have put themselves in a situation that is quite tricky to resolve, basically.
Yeah, the central banks really have the problem that they always go too far when they lower rates, like they did for too long, of course. And then they had to raise rates, and they will probably raise rates too long as well. We don't think that it will be a soft landing, but if they keep it as they say, I mean, it's easy to talk tough, but if they keep it for longer and higher, we think the system, there will be a crash in the system somewhere. And of course, they will have to pivot then. But then they have the reason to pivot. So probably they will go to that point. And when it happens, we don't know, of course, but for sure it will happen. We see a lot of signs and the statistics coming out that there are so many. I mean, I only read about layoffs in the US from the big companies, and still they have more jobs. So I don't really get that statistics, but it's a bit strange. But really on this picture, we have seen they have tried to shrink their balance sheets. And don't forget, I mean, what happened in 2008? I mean, that was exceptional, sensational growing of the balance sheet. And now it looks like almost nothing. But at that time, that was never seen before. I mean, that rescue for this financial system was wow. And now it's like just a small dot on this chart. And now we see the balance sheet is coming down. But as we also see, the last 4 times it came down, they had to go in and back up the system again. And we think that will happen again.
We've got another question here. How do you see gold supply versus central banks demand alone? So how much impact will it have, the central banks buying on the overall supply of gold in the world?
Well, it comes back a little bit to this COMEX physical situation. We see it's really tight, and we have a lot of different buyers for gold. Central bank is one group. Then we have all the investors or people in Asia who buy a lot of physical gold. And then we have all the ETF or in Europe ETC buyers that also compete for the gold. So there will be a lot of competition for the physical gold, but still COMEX that do a lot of paper trading still dictates the price. So we really think when the COMEX does not dictate the price anymore, it just has its normal, should have function. The competition and the price will go up a lot. Yeah.
So let's see. And we will talk a bit more about miners in a bit, but one really important thing to understand is the relationship between the gold price and miners when investing and how much of each of these asset classes to include. But since they have a direct relationship, of course, since the mining companies are mining gold, and we usually see a leverage of, we say, around 2 to 3 in the equity.
Yeah, and I mean that happens because if the gold price goes up 10% or 20%, the producers, they have a cost for mining the gold. So the difference, the same amount of dollar price going up, makes a much higher percentage of the revenue of the miners. So that's why they can really go up much more especially in the secular bull markets. And when we say this, that we calculated, or we think it will be going over $2,100, meaning a 10-20% higher price in US dollar. We haven't written this here, but I would say I think the dollar will come back down. So the return for a European investor in euro may only be 10% for gold. But of course, if the dollar goes down 10% with the euro, you will only see a 10% return as a gold investor. But what is interesting here is if you go for the miners, this leverage we talked about happens before the FX. So if it goes up 20% in US dollars, and we have this leverage of 2 for just making an example, the miners would go up 40%. And then again, you would lose the 10% on the FX because the dollar is losing to the euro. So you would have a 30% return. So then it would be 10% for gold alone and 30% for miners. So that's a really, really interesting situation when the dollar comes down.
We got a 2-part question here from Tim. So do you calculate and monitor a fair value for gold? And if so, what are the inputs to the assessment?
Yeah, we have done that. It's not really, really important for us as we are long only all the time because we believe in gold even when it goes down, because it's a long-term investment. We did have some calculations adding. I had a formula with the debt amount in the US and the Fed's balance sheet. At that time, we got a fair price of $3,000. So now we are far below that. So it doesn't really work with the reality, but I think that depends on this paper trading and maybe that the market still believes too much in central banks talking. So that we have a fair price. It doesn't really mean that we are not going to sell even if we go overshoot this fair price. But that's what we see in the future. And in the end, everything depends on how much more money, how much more debt will be created. And don't forget, we had a debt crisis, financial crisis, 2008. Now we have twice or more than twice the size of the debt in the world. So we haven't solved the problem. We always solve it with liquidity. Always the same solution in the end.
Yeah. And I think that was also answer to the second part of the question, which is if we would reduce holdings based on this, but we don't. That's the short answer because we are long-term investors and we rather see it as a buying opportunity if it goes down.
We leave that decision to the investors. Yes.
Yeah. Let's see here. We have a few slides also about silver before going to the miners. And as we can see, here's the chart of the gold-silver ratio. And it should go below in 30 in an upcoming bull market. And that's how we see it. And it's an interesting metric to follow just to see the relative price of these two assets.
Yes, what we do see here is, I mean, we have been going for an average around 80, 90, and that's really, really high. So silver is cheap relative to gold. And in a bull market, a secular bull market, it normally comes down to 30 to 1 before it, in a bear market, turns to the favor of gold. But you should know that the natural occurrence in Earth is 16 to 1. And that was also the relation that Newton set, and was the real relation for a long time in the old days. Now it has come up and we see an average of 57, but natural occurrence is 16 to 1. The problem is we have difficulties finding silver, and silver is needed everywhere, the second most used commodity in the world, and getting close to physical shortage. So we actually believe it could go lower than 16 to 1 and even below 10 to 1. But that's we don't count on that, but we believe this will be the time, and especially the time for silver to shine, as it's a very, very interesting commodity. And just for an example here, now gold is not at 2,000, but it's easier to count. If it's in the coming years goes to 3,000, that would be a 50% return, if I count correctly. And silver is not at 25, it's below that, but counting at the same relation. And if we just go to the 30 to 1 in a bull market, that would give a price of $100, and that would be a 300% return. So this just an example that shows how interesting silver is in this upcoming period, upcoming years.
Can cover some questions here. We got one from Håkon. I believe silver is gold on steroids and silver miners is silver on steroids. Are there any good silver miners to recommend? And you can actually find all the holdings of AuAg Silver Bullet directly on our website. So you just go to the fund page. So those are the silver miners we like.
Those are the ones that I like, and AuAg Silver Bullet is our first fund and flagship fund. We named it Europe's riskiest fund because it's a very volatile market, as you also mentioned there. So we come back to that one a little bit later as well.
Yeah. We can take one more question while we're here. So related to gold. So from Bjorn, how do you view dilution, so the production of new gold in the gold market, affecting the price going forward? And how much is the annual production in relation to mined quantity?
Yes. So what is important here that all gold that is mined, has been mined, is still up here. It doesn't disappear. And it has been around 2%, but I would say it has come down to 1.5%. And that was the reason why it was interesting to have gold as and a gold standard. We don't believe or hope for a gold standard, but that was a reason for it, because it normally grow with 2% a year. And I don't know if it's a coincidence, but the central bankers, they always talk about 2% inflation. So that may be it.
We'll proceed. So time for silver. The silver is definitely my favorite metal, and I'm sure I know it's yours as well. But what's unique with silver is that it has a dual demand. It's both money and it's also used in the industry. So what's here is an example of cars, basically. And we can see that the forecasted demand for cars in the future, just for silver, is just going up. And it has to do, of course, with electrification and electrification of our transport. And this trend we can see in a lot of products, and also all the new green tech products that are coming out, so solar panels and wind turbines and batteries.
So as you said, Christoph, I mean, silver has, it's the only commodity in the world that has this dual demand, with 50% coming from investors and 50% from the industry. As gold has only 10% from industry and 90% from investors, and other commodities are only coming from the industry. So it's silver is very special here, and silver is also very special in the electrification. Even if it's a bit or a lot more expensive than copper, silver is the metal or any element on this planet that leads electricity and heat, the best of all elements on this planet. So you cannot sometimes use less silver, but that's hard. And we need silver in everything, every mobile phone, every computer, every car, solar cells, everywhere we need silver. And we are getting really close to a shortage, and a shortage on a commodity that makes prices spike straight up. So that's really interesting to get into the market before that happens. And we can see it. It's the turnaround on the reserves on the COMEX and so on. It's really turning a lot. So we really see that coming. It hasn't happened yet, but when it happens, it will just explode. And again, one more thing with silver, the price is inelastic, and that's a very interesting property for the investment, because inelastic means you use very little silver. If you use only 30 grams in a car, but you cannot do a car without these 30 grams silver. So even if the price goes up 300%, as we said, it doesn't really change the price of the car. So Volkswagen, Mercedes, they just want the silver, and they will pay anything to get it, because without these 30 grams, there is no car. That's it. So they would pay anything. So even if the price goes up 300%, it will stay there, and the consumption will stay there. Comparing it with oil, if it gets really, really expensive, we start to use less and the prices come down. But this means it's inelastic. So that's also a very interesting property for the coming years for silver investments.
Yeah. Okay. Gold miners. I see we have gotten a few questions about gold miners, but we will continue, and I will try to read them, and we will sprinkle them in along the way.
Yeah, because we have a lot of slides, and of course this is from the outlook that we made in December. We think everything is still true. We still believe in it, and we wanted to focus on the gold miners because it's interesting, because we have of course the silver miners as well, but we have two funds, one towards gold miners, an exchange traded fund. That's why we made this outlook for them, especially for that ETF. And then we have the Silver Bullet, a daily traded fund. So this is maybe a little bit difficult start, but I think it's an interesting observation. Gold miners have had a tough period for many years. And one reason for that is the creation of the gold ETFs and gold ETCs. Because back in the days, if we go back 15, 10 years ago, a long time maybe, but still, everybody looking for gold exposures had to buy gold miners because there were no gold ETFs or gold ETCs. So, but they actually maybe just wanted the gold as a commodity. So with this creation during these years, some or maybe a lot of investors have sold gold miners to buy the gold ETFs. So that has been a competition for the gold miners. But what we want to say is this trend, this period is over now. So now it's cleaned out. The investors that hold the gold shares, the gold miners, they are there. And the people who want to have gold ETFs, the commodity, they are there. So it's cleaned up, but it has been a drag. That's my observation for gold miners, and explain a little bit why gold miners have had a tough time during this last 10, 15 years. But what is important is this is over. So the prices will not be hurt because people leave gold miners and go to gold ETFs anymore. So that's, I think, an important observation. And again, I go through these ones as fast as I can. I hope you can follow me. Again, gold miners are therefore also cheap compared to gold. So that's what this chart says. And you see it's below the average, rather far below the average. And that means it's a good time, or a good time, but looks good, to buy miners instead of gold as a commodity. And when we see a bull market, of course, gold miners will go really strong. And this chart, the prices, it will revert and it will overshoot and come up to the highs that we can see on the left side again. And then at that time, it's probably good to maybe sell some of the gold miners and buy gold if you still want to be in the space. But today is the time for gold miners if you want to buy low and sell high. What is good for miners is that during this last 10 years, if you follow the blue line here, they have lowered their debt a lot. And that's very special because in most sectors, companies have raised their debt and doing buybacks with this new debt and so on. that has been good for their share prices, going up, but it also puts the companies in a worse situation economically. And gold miners have done the opposite. They have reduced their debt, and we think that's really, really good. And in the last 10 years, we can also see that the gold price is up a lot. So that's really good situation. And as I said, the gold prices have been going up. And if we see this chart, it's in euro, dollar, and Swedish kroner. And it's the last 5 years. And gold price has gone up 60% approximately in euro. And of course, that's good for the miners. It's good for the bottom line for them. We can also see it has gone up in US dollars, only at 37%, but still, that's a lot as well in 5 years. And we think also that the US dollar will give back a lot. It has been really, really strong compared to other currencies. So maybe next year these lines will go back together again, because you can see the difference is the last 2 years between the euro and the dollar price. And we think these will come back together. And of course, we are in Sweden, and gold has been even better for a Swedish investor to protect, because the currency has been even weaker than the euro.
And this was probably one of the most common questions we received last year. I would say that the difference of investing in gold in different currencies.
Yeah. But when you change back, you always have the same results.
Yeah.
So it doesn't really.
It doesn't matter.
It doesn't matter.
If you're Swedish, it's Swedish kroner.
Yeah.
If you invest in euro, it's euro, and so on. We can actually sprinkle in some questions here about miners. So we got one from Trond. How will the higher energy prices work for the gold and silver miners? Total cost and revenue.
That's a good question, because I'm coming to that actually on the next slide a little bit. It fits well if we go there. And because this is before energy prices took up. So the commodity sector had really good cash flow. And the sector with the best cash flow was the miners, the gold miners, or precious metal miners, what we can see on the chart here. Then Q3 was not that good because of the energy prices. I mean, they really spiked up. So Q3 reverted a little bit of this first half in 2022. And but I mean, electricity prices have come down again. So I think Q2 was 1 and 2 was really good. Q3 was had some much more higher cost for the energy, but I mean, energy prices have come down a lot again. So I think Q4 and now going on is looking really good again. So it's not that problem, but Q3 it was a problem, but that hasn't continued. So we don't see it as a big problem today. And now we are spoken about the margin, so I just keep on going because so we get through all the slides.
Yeah, go for it.
Well, here we can see gold miners. They were really not behaving the best on the last gold market up into 2011. They were doing too many expensive projects and too many good conditions for management and so on, and exploration here and there. So they learned a lot. So they've become much more share owner friendly, and they've been careful with exploration. However, we can see that exploration has started to coming back. Of course, with the higher gold prices, it gets more interesting, and it's hard to find new gold. So it has come back, but still it's not on a very high level because they are careful where they spend the money, and they want to be much more share owner friendly. I think that will be good for the equity prices. And what we see in the sector, if we go further on, it's the MAA is really strong in the sector, and I think that's a good sign. Now we have last Newmont wanting to buy Newcrest. I mean, it's the largest one, want to buy number 4. So that's a big one. We have Pan American and taking over Yamana with Anico, and we have seen some other mergers or acquisitions as well. So it's really, really interesting, and we can see that the sector is fragmented as the 5 top producers. They are really, really big ones, but still they are only 17% of the market. So a lot of things can happen with the M&As in the sector. And of course, if you are on the right side in M&A, you will get a lot of premium on that equity. So that's also very interesting for returns. Another interesting part, if we go on, is the buybacks. And at last, we start to see buybacks from the miners. And of course, it's from their better cash flows, profits, debt reduction. They have money. So they have been doing buybacks. And you can see it's a record share buybacks because they didn't have that before even. So now it's there. And the good thing is they don't do it with additional debt. I mean, as we said before, most sectors, they did a lot of buybacks, but they did it with new debt because there was money for free. Miners have not done it that way. So I think that's also a very strong sign for the sector. Another thing that we think will drive equity prices is that, as we saw 2022, as Christopher said, the 60-40 portfolio, the old one, didn't really work. We think that the large institutions are looking everywhere. Where can they find returns, alternative returns? And we really think commodities, gold, silver, is that one part of that solution. And when institutional money, as it is owned by a lot of institutions, there is a big buying group there. So it's a big potential when they go into this market. It's a smaller market, not a small one. I mean, gold trades as much as all S&P 500 companies every day. So it's a very liquid market, gold, but still it's under-owned. So there's a big potential of them coming in, adding some percentage to their portfolios. And of course, that will drive prices a lot as well. So that's also a very interesting situation. And for an institutional investor, we can see that gold miners have a correlation about 0.3, we like to say, in the long run with the broad stock market. So and gold is almost down to zero. So it's a really interesting, I mean, it's a still straightforward, long-only investment, but you have a very low correlation. So it is perfect for the portfolio. So we see more money coming from institutions into the space. And it's not only Ray Dalio and John Paulson and these guys, but also other pension funds coming into the market. And of course, that will drive prices for earlier investors.
And then we have a similar slide to what we showed before, but here we have the gold miners relative to the S&P 500 instead of the overall commodities sector. And what we can see here is also that we are in a quite unique opportunity here, where the valuation of the gold mining sector is very low in relation to S&P 500, and this means that it is a great entry point to scale up that part of your portfolio, basically, we showed in the beginning.
Yeah, we really think this will again, like always, go back to the average and then overshoot as it did 2008 and go up there high up there, and then of course again it's maybe time to sell some miners, but this is a good entry point, a good valuation.
Should we take a question here? I think we can take here one from Tim. Would you agree that some of the relative cheapness in miners, that they're low valuation versus metals, is the increased funding cost, their increased funding cost, and that they now that they have to deal with?
Not really. I mean that is interesting when you buy miners to see. Sometimes you want miners with a low production cost, because it's a safer solution. On the other hand, sometimes it's good to buy miners with high costs, because when the prices of gold rises, the percentage change of their revenue is much higher. So that's a rather interesting thing to invest. But I mean, if they have a higher prices, some have higher prices to mine their gold, you have a higher risk if the prices go down. So it's a two-sided sword. So not easy to answer with a straight answer on that one. As we said, we like in this market, we like the mega caps, the really, really big ones, but it's a sector. And when we construct a fund, we try not to be too much of the market index, because the market index is dominated by 2-3 mega caps. and they don't have the highest return potential. So we think large cap and large mid cap have much higher potential. There's still not the risk of small cap or explorers or everything, but they're a little bit smaller than the 2-3 mega caps. And these are the companies that have a higher return potential. And we see that through history. There are no funds for mid cap, but they are actually the companies that have the best returns over the long run. So we like to have that in our funds, and not to be the index, but to do a smart beta construction of the market.
Yeah, many of our peers or competitive funds or similar mining funds, they are market weighted, I could say. So we try to do equal weighted, tilted equal weighting.
Yeah, an equal weighting of the funds or different target weights, but still getting more to that to an equal weighting gets a better return potential.
We can take another question here from Håkon related to selecting mining companies. So just the method of selecting a mining stock, like what do we look at?
We have first of all, we like to see the liquidity in the stock because we are fund managers, so we have to not just buy, but you have to sell, and liquidity in a stock is really important when you have to sell. So liquidity, so it depends on which stock market. We like to have them on the big US stock markets. And secondly, we look to how much silver do they have, or how much gold do they have, the percentage. And you have to be a bit careful because it's about revenue, and revenue is decided on the gold and silver ratio. So you have to look through that a little bit, but still, what metal are they really mining and not? Third thing is for us is jurisdiction. Where do they mine? From where do they have their company? Where is it? Is it in Canada, but maybe mining in Mexico? That combination is really important. Which countries are good jurisdictions? And then it's a lot about management because it's rather cost-intensive industry. So mistakes there are very expensive. So these are the big 4 factors for us. Shall we go on? Because we have running out of time. I think so speeding up a little bit.
Yes. So one thing that we can say that will put a premium on these mining companies is that the ones who are more quickly adapting to ESG legislation and ESG activities, they will have a premium, and that's why we have taken such an active stance on how to include active ESG screening in our work, since we will need the miners to build all the green technology and the other technologies. We will not be able to build anything without metals, basically. So, but then we need to find the companies that do it the best way. And the ESG-friendly companies, they will also get capital inflows from institutional investors because institutional investors, they can't buy a company with a high ESG risk for that sake.
And our approach is not just buying the best in class, but also to communicate with the companies actively to make them better. And they are getting better, a lot better. A lot of things are happening. Miners are really modern and they are very easy to communicate. They are better than other sectors actually to answer ESG questions. And even if doesn't matter if we think this will drive prices, it will drive prices because so many big, large institutions have to go through this way. So even if it wouldn't be important for us, it is important, but even if it wouldn't be, the market will do this for us. So I think it's a good way to run to get better returns as well, because the market will pay a premium for the best companies. And again, we said they were share owner friendly, the miners, and we see that on dividends, and they are raising the dividends. That's the gray line here, and the blue line has been the S&P 500. So we can see they have a good trend raising dividends, and I think we have Newmont at 5% already. So and our ETF had over 3% dividend. So it has been, our ETF has been actually like a dividend ETF. They were also around 3%. So of course, everybody is coming up now with the dividends, but the miners are leading and they have a good trend for dividends as they have such good results.
Okay. So now we have not that many slides left, and we'll try to cover a few more questions. But just to briefly mention how what we have in our product portfolio basically is these 4 funds. And what you can see here is top right corner, Silver Bullet, which is our first fund. It's a silver mining fund. This has the highest risk. We actually say it's the riskiest fund in Europe. But it's due to its volatility. So, and that can also be used to, of course, generate returns if you sell when it has increased quite a bit, and then it comes back down, and then you can buy again. We have our AuAg Gold Mining, which is an ETF. So it's available in a few more countries, actually listed on 5 stock exchanges across Europe. We have AuAg Essential Metals, which was launched on this year on the 2nd of January, which is fun. And it's a broader metals portfolio with green tech metals and earth tech metals and industrial metals. And then we have our multi-asset fund, which is Precious Green, and it's the 60/40 portfolio we talked a bit about earlier, with 60% green tech equity and 40% physical gold. But mostly related to this presentation is these 2 funds.
And of course, AuAg Silver Bullet is passported to Sweden, or it is from Sweden, passport to Norway, Finland, Denmark, and Germany. So it will be available for retail investors or if the platforms have the funds there. For institutional or professional investor, of course, it's available anyway, and you can buy it in euro or Swedish kroner, trade it. And the gold mining ETF is, as Christopher said, on the London Stock Exchange, Paris, Frankfurt, Milan, and Zurich. So that's very, very easy to buy there, everywhere in most countries in Europe.
Yeah. Amazing. And make sure to follow. That was the last slide. And make sure to follow us on LinkedIn and Twitter. We also have a newsletter that we send out monthly. You can sign up on our website, auagfunds.com.
Yeah, and we are really active on LinkedIn and Twitter to answer questions.
Reach out to us. Yeah. We didn't have time to answer all of them now. I think we have a couple of minutes left.
Maybe
so
we can make one more or 2 more.
Yeah, I think we have 6 minutes, so let's make the most of it.
Yeah.
Is gold and silver, I think this is also an interesting question. Like, what metals are mined in the mine? Like, if it's a gold mining company, what else do they get?
Oh yeah, that's a good one. Because no company mines only gold. A gold company, if they find copper, they take that out as well. Normally, there are different combinations, but I would like to say gold and copper is very common. Gold and silver is common. Silver and copper is common. These are the big ones. We think copper is very, very interesting because you cannot exchange copper, and the copper is so much needed you need 50 kilo coppers in a electric car instead of 20 kilos like in a normal car. So, we need the copper. Lithium, and so you maybe can find a smarter battery, but copper will be there. So copper is really, really interesting. But again, silver again. Why is it so interesting with silver? Because there are so few primary silver miners, because silver is very often a byproduct from another miner. And these big companies that have silver as a byproduct, if silver prices rise because of physical shortage, they cannot just start to mine more silver. They have to mine everything they mine, and they cannot do that. So they will not raise their production. So it's only the primary silver miners that can really go in and raise their productions to try to meet the shortage. And of course, that would be really profitable for these primary silver miners. And they are few, and they are important to have in the fund. And that, very interesting.
Next one. A good question here. How do you choose which transferable securities to buy in your funds, and how do you consider counterparty risks?
Yes, well, we have what we say, no counterparty risks. We have the risk of the companies doing a bad job or going bankrupt, but we don't have any other. We don't like third-party risks because we are in love with physical gold, so we want everything to be secured, and also the funds we don't hold the assets. It's the custodian that holds the assets, so there is no risk on us as well. So we look at risk a lot. We even looked 2019. We started to say which countries do we not invest in the jurisdiction. We excluded 100% Chinese companies, the Chinese owners, Chinese mining, difficult companies in Africa, and we actually excluded the Russian companies 2019. So that was in our risk management, and I think that's rather interesting. Not like many managers maybe coming out after the war and saying we have de-invested in Russia. That was a decision we had. We could have had a different decision, but it was on our risk decision map, and we made that decision 2019, not to have that in our silver bullet fund. So yeah, it's important.
Yeah. From Fredrik, how do you make sure sustainability is an aspect in your investments? And that is a great question, because as we mentioned a bit before, mining companies, they are like a crucial part of our economy and our world to build products. So we need to have them, and our stance is that we need to find the best ones with regards to both for fitting the fund to get returns, but also like, are they sustainable and are they taking care of their employees, the environment, and so on. We have a separate page on our website where you can read a lot about it. But in short, we buy data from the world-leading ESG data provider, Sustainalytics, as one part of our ESG process, and we have ongoing dialogues with the management in each holding in our fund.
And what we can see here is, like in our silver bullet fund, it's difficult to get a high ratings because we have smaller companies, and smaller companies have difficulty to get good ratings as of today because they don't have the resources to make all the reports. And I think the active contact with the companies to make change. I mean, if you make change, if we can make a miner make less whatever pollution or something, that's a big net change for the world. So we think sustainability in a different way. It's not about just holding the companies that look good, but to make a change, because the net effect, we have to be active as managers, not just passive. On the other hand, our ETF, the gold mining ETF, it goes for the best-in-class companies only, and it has 5 globes on Morningstar and AAA on MSCI ratings. So, and they are all Article 8 funds because we are this active ESG work, doing the ESG work and promoting change. So we are really taking it away. But first you have to understand we need the mining. We need the metals for the green world.
And I think that might have been the last question. We didn't have time to answer all of them, but we have 1 minute left, and it's actually 12 now. And I think Mugens has some final words.
And we may have another meetup.
Yeah, we will have one next quarter as well. So keep a lookout in LinkedIn and Twitter, where we always communicate. And thanks a lot for joining in and asking all these great questions.
Yes, thank you very much, guys. Always a pleasure to have you around. Always a pleasure to listen to your views on a sector that may be less accessible for people that doesn't know about any of this stuff. And certainly you have made a great case. Any questions that have been unanswered now, we have the questions. So I'm sure you guys will be happy to reach out to the guys who posted the questions and give them a reply. With that, we'll end this webinar, and we will get ready for making the replay available as soon as possible. So thank you very much for attending all, and thank you very much, guys, once again.